You had that report out by the Committee for a Responsible Federal Budget kind of saying either way you go, either presidential candidate would add a lot of debt to the economy. The degree of range here is stunning. 3.5 trillion for Kamala Harris, 7.5 trillion for Donald Trump added through the next decade, according to the report. What does that mean for where treasuries go?
No, that's a great point. The long end of the bond market is a very, very technical segment of the market. You know, buyers and sellers are out there for very specific reasons. You know, long-dated issuance, funding, meaningful capital, or funding for governments. And then the investors that invest out at the long end, typically have liabilities. It is not just sort of a, there's a trader's market, but it's very, very technical. Now, your point about supply, Treasury supply is clearly high and going higher. One of the issues will be not so much just the notional volume of debt that the government needs to issue to fund itself, but the duration of that debt's going to get longer. Bill supply went up dramatically over the last 12, 18 months. That is likely to come down a little, and the government will have to refi longer and longer duration positions. So finding those buyers is going to be a little bit more tricky than it has been. And then you sort of layer on what's happening fundamentally. And as we just mentioned, the economy is doing well, yet the Fed is cutting rates. And so the long end is on edge, so to speak. We haven't even mentioned the potential of the political changes that may ultimately spur, sort of further spending. So we take kind of a cautious, a cautious approach to the long end, which is one of the reasons why kind of that steepening bias to us is better way to sort of express fixed income portfolios than having a longer duration bias. The rule book tells you when the Fed's cutting rate, buy long duration. That's historically what has worked. That is not necessarily the right decision in this environment, simply because the Fed is not cutting rates in response to a slower economy. It's cutting rates in response to lower inflation.